Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 57 of our YouTube channel and podcast, and I could not be more excited to continue talking to you guys about personal finance topics that I think can be really helpful to you in your long-term financial wealth building and your push towards financial freedom. Today, we are going to talk about a conflict, a dilemma, if you will, of once you jump over a lot of financial hurdles, and there are a lot of hurdles to jump over, having savings, saving for emergency funds, being able to get out of debt, buying homes, taking the employer match and investing, starting investing, all these different hurdles that you have to jump over financially. And then as life moves on, there are less and less hurdles to jump over, but a couple tend to remain. And those couple are investing for retirement and paying off your home. And so these hurdles are still around for most people. And so today I want to speak to where should you be directing your attention? Should you be paying more on the home or investing more, or what should you be doing? And how is this going to affect your financial life based on the choice that you make? So you're going to hear my opinions and some fact to back up those opinions. But before we get started, if you could, go down below, hit the big red subscribe button, like this video, the big thumbs up, click that for me. Also, leave me any feedback in the comments, any just questions or comments you might have for me. I will make sure to get to you if you leave those in the comments below. If you're listening on Apple or Spotify podcasts, thank you for listening there. If you could, just make sure that you subscribe and leave me a review on either of those platforms. Also, follow me on social media at MNO with Dylan. That is a really good follow. I put out a lot of really good information that I think you guys can benefit from day by day, along with these videos, to really push you towards learning the most you can about maximizing your financial life. And then last but not least, if you feel like you're in a place where you need some help, help either starting or continuing your financial freedom race or whatever it may be. If you need one-on-one help, then you can sign up for financial coaching sessions with me on my website, www.mnowithdylan.com. And you can click on the Work with Dylan tab and choose the financial coaching session type that would work best for you. And we can begin to build that relationship and begin pushing you forward in your financial life. So when it comes to investing and paying off the mortgage, let's first remember what my guidelines are. My guidelines start with the financial action plan, quite obviously. And what the financial action plan is going to tell you to do is to get out of debt and to save 4 to 6 months of expenses in an emergency fund, right? Those are steps 4 and 5 in the financial action plan. 1 through 3 are budgeting and then making sure you have 1 month of expenses in emergency fund, and then taking advantage of the employer match if you can. But the real hurdles to get over are the paying off of your consumer debt and having the 4 to 6 months of savings of emergency fund there sitting for you. So we want to make sure that we have all of that done. And then we want you to be investing at least 15% of your take-home pay, of your income. We want you to do that to obviously benefit your retirement, benefit your kids' college, if you would like to save for that. It can benefit you as far as bridge investing. So if you want to invest to retire earlier and get to a different point in life earlier, then you can do some bridge investing. It can help you to invest for things like if you're going to purchase real estate or any of those types of things. We want you to be investing at least 15% of your income to do that. So obviously that is my first guideline that I have there. But at the same time, what you should be working on doing is paying off the house early. That is the step right after investing at least 15% of your income in the financial action plan. And so if I want you to be paying off your home early, the question comes in the simultaneity of these actions, right? They're occurring simultaneously. They're occurring at the exact same time. We're investing and we're paying off the home early, so we're putting more on the home. And then the question becomes, well, how much do I put on each, and why? And why can't I just do this, or why can't I just do this? That's where this question comes from. And you can choose to invest more than 15% of your income. I said at least 15%, but any more will obviously slow down your ability to pay off your house early. But in a similar way, any more that you put on the house will decrease the amount that you can invest for the future. So it is definitely a struggle to determine which you should do, but we're going to talk about that as this video progresses. So what do I really think? What do I think you should be doing? Well, obviously it depends because everybody's life is different. And at the same time, I think you should be doing both. And we'll talk more about the benefits and the costs of doing both as we walk through the rest of this episode. So let's talk first about if you were to just be investing without adding to your house payment. So you're simply just paying your normal mortgage payment and you're investing all the while. Okay, so if you're doing this, then what are the pros to that? Well, some of the pros would be pretty obvious. You would have more money later, right? Because you are investing more money for the future and your money would have a chance to grow. So obviously more in, more out. The more money you put in, the more money you'll be able to get out later. And then your money will be growing at a faster rate in an investment than it will the mortgage, right? You'll have this historic in stocks 10% rate of return versus a 3-4% mortgage. If you have good credit, then that's quite the spread. So you would be making a big clip over the mortgage, but we'll talk about why that's not a healthy way to look at that later on. And then you can still pay the house off on time, obviously, because you're making your typical minimum house payment. And then you'll be able to make sure that nothing is underfunded. So you would have your retirement well funded, you would have the college funds well funded, the bridge investing well funded, any investing that you do for purchasing real estate or any other types of things well funded. So everything would be so well funded, and you would probably be able, when you got to an older age or to retirement, to handle the house payment that you would have at that point, because you would have so much money that you had accumulated and acquired over time that you didn't have to worry about the size of your house payment later or the fact that you had a house payment later, because that is typically your largest expense and you want to get rid of that as you get into your older ages. But if you had been investing that whole time, you could probably take care of that, and that wouldn't be a big issue for you. So those are the big pros when it comes to investing without adding to the house. But let's look at the cons as well. So the first and most obvious con is that your largest expense stays around. So housing costs are typically our largest expenses, and this expense would be sticking around and you would still have it. You wouldn't be able to experience the financial freedom that came with paying your home off and having all of that extra cash that you used to be putting towards a house payment. So your largest expense will stay around, and then you'll end up paying more interest on your mortgage over the long term, because the earlier that you pay off your home, the less interest that you pay over time. And that's just really basic math. And so you would have a more costly mortgage by not paying it off quicker. And then you may have a house payment in your golden years. Like I said earlier, you may be able to deal with it and pay it, but who wants to be paying on a house in their golden years? Who wants to be paying on a house when they are already retired? We want to decrease our expenses as much as possible so we can really maximize our income and live our lives to the fullest when we hit those points in life. And then even further, you'll have less availability to increase your investing into overdrive later, because if you don't have a house payment, then you can invest what that house payment was, and you can really bump up your investing really hard. Well, if you don't really get huge raises over time and you're investing and not paying more on the house, then you'll never really get that chance to push that investing into overdrive because you don't have the extra cash to do so. And your financial balance can get a little tilted here, because what you'll end up doing is putting so much money into the investing portion of things, because you have to keep that up, or else it doesn't make any sense to be paying the mortgage at a simple rate, at the rate that they want you to pay the mortgage. Then if you're just doing that, then it gets your financial balance a little tilted out of whack, because then you can't really give more and spend more because you're so worried about investing and making sure that you have enough in the longer term. So you can get a little tilted in your financial balance there, which is a big con, because you don't want to get that way. You want to be doing everything in some proportions that are comfortable to you in your financial life. And then you'll yearn for the freedom financially that the investments that you likely can't touch anyway, because most retirement investments you can't touch until 55 or later, and in most cases 59 and a half or later. So if you can't even touch those investments yet, then those things won't be real to you. It won't be something that you can realize. You won't feel the freedom of having those investments until you can start pulling from them. But the moment you pay off your home, then you can feel the freedom of paying off your home. You don't have to make that house payment anymore. Something changes within you. Something changes in your financial life, and you won't be able to feel that if you aren't paying your home off early. So that's just how you would look at it if you were going to just focus on investing and not paying off the mortgage early. So now let's look at the other side of things. Let's say that you are adding to the house payment, but you're not really focusing on investing. The pros to this would obviously be that your largest payment would be gone in a flash. You would have your house paid off pretty quickly, and you would have that largest payment taken care of. And then you could give, save, and spend in very large free amounts, right? At this point, you will experience that really strong financial freedom that I've talked about previously. And you can go about your life not worrying about housing costs anymore. And if you want to move to a similar cost house, then you can move and just pay closing costs on that, and you're all good. And just make sure that you're paying your taxes and insurance, and everything else is cool. And then at this point, a real big pro is that the amounts that you were putting on the house should have been so crazy that you pay the house off really, really early and leave you plenty of time to just stack on to investing. But there are distinct cons to doing this as well. And those are, your compounding of your money was given up. You gave up compounding your money at a high rate. Yeah, you're paying off a 3 or 4% mortgage, but you're not able to get that real good compounding effect and growth that is so important with your investments. And so you gave up some of your time. And this may force you to lack some investments later on in a particular area of your life. But like I've said previously, the payoff to that is you won't have that large expense. But that is a particular con that you would have to deal with and have to reconcile in your own life. And then you will have given up time, like I said, which is absolutely key. It is crazy how much difference there is in 5 years and beginning to invest with intentionality. Or 10 years at that, for that matter, just investing as early as possible and getting your money growing and compounding as early as possible is what's going to make the difference in your long-term financial life. And so not doing that can be extremely costly. So that's a con to this as well. And you'll be out of financial balance. You won't be flexing that savings muscle, that saving and investing muscle, as much as you will be flexing the spending on debt muscle, right? It seems like, an investing, saving muscle, but it's a little bit different than investing in your true investments. You're paying off a debt. You're paying off your mortgage. So you'll be a bit out of financial balance in that way. And then the majority of your assets, once you pay your home off, will be tied up in something that is illiquid. You can't, get your hands on that unless you take out a second mortgage, which we've talked about why that's not a good idea. So it's really going to be beneficial to you to what? Like I said at the outset of this video, make sure you are doing both. You want to be not just investing and paying minimum on the house, and not just paying all on the house and not investing. You want to be doing both to be making good progress in that way. So what is doing both going to look like? Well, I said previously, invest at least 15%, right? Invest at least 15%. Well, I would say a lot of this needs to go into retirement accounts and bridge investing. So you need the money more than your kids need it. Obviously, your kids can find ways to pay for school on their own, but you have to save for you. And so you can take advantage of the tax advantaged accounts like the IRAs, the 401ks, 403bs, things like that. And then go to bridge investing if you have other things to invest for, like real estate or early retirement, things like that. And then I say at least 15%. And that's a little bit of ambiguity, but it gives you the space to make some decisions for yourself. And so the fact that this is a little ambiguous, it's not a big deal. I just don't want you to get too crazy and invest, 50% of your income. That's not what I'm saying, because you won't be able to do all the things that you need to do financially. The way that you're able to do what you need to do financially is keep it a little above that 15. So typically 15 to 25 is a safe range. And then make sure that above the 15%, you have room to put extra on your house, because if you don't leave that room, then you're going to just be doing the one and get out of balance like we were talking about a moment ago. And so you want to make sure that you can still cover all the things that you need to cover and pay your home off early. And that's going to be beneficial to you in the long run, not just investing. So if you can pay for all the things you need to and you leave a little extra room for the home, then invest away. Invest as much as you need to, as much as you want to, but make sure you leave a little extra room for that house payment and then all the things that you want to do in spending money on your own. Now, paying off the home early is not a really hard proposition. So just adding a few extra $100 a month, so $200-$300 a month, can make a huge difference in how quickly you pay off the home, whether or not it seems like you're making as much headway. You may think, well, this is a huge amount of money. Wouldn't I want to make big chunk payments? Well, you could, but doing $200 or $300 a month can be very effective. So let's talk about this example. This is an example I've brought up previously, but I think this would be useful in this context as well. So if you had a $200,000 mortgage on a 15-year fixed rate mortgage at 4%, okay, so I've brought up this example before. $200,000 is the median home cost in the United States, so that's a good amount to set there. And you just added $200 to the monthly payment, okay, so $200 each month you add to the payment. That would pay off 28 months early. So instead of 15 years, that would pay off in 12 years, 8 months, right? And so that $200 a month gave you 2 years and 4 months of more freedom, from the biggest expense that you have. So just $200 a month does that, and then $300 a month pays it off 38 months or 3 years and 2 months early. And so you see, just adding those amounts, those aren't insignificant amounts. Obviously, if you had $200 a month all year, that's $2,400 you didn't spend on something else or invest. And then $300, that's $3,600 over the course of the year. But you can really knock down the amount of interest that you would pay on a loan if you did that. So what I would say is try to set an extra amount that you're going to put on the home, and just leave it. In the same way that you set your investing and do systematic automatic investing, to make sure you do the same with this house payment. That way you're not getting too crazy with the house payment and have to simmer down at some point because it's taken away from your ability to do other things in your life. And then let's say we get some extra income or bonuses or something like that going on in the household. Well, at that point, it's up to you. But I think that it would be best for you to split it up in some way for the sake of financial balance, because you don't want to get too heavy in one spot or the other. But whatever you feel like the best thing is for you, because it is extra money, then absolutely do it. You can split it up, you can lump sum it, you can do whatever you want to do, whether it be on the house or investing or whatever you may feel like you're a little behind on. But like I said, doing a little bit of both, it allows you not to get too tunnel vision. It allows you to keep that idea of, okay, we're being balanced, we're keeping our attention on all the things that need to have our attention and doing the things that we need to do to get ahead financially. So I would suggest doing a little bit of both, but if you don't, I'm not going to sue you for it. It's perfectly fine if you choose to put it all on one thing or the other. So why is investing versus paying off the mortgage such a conflict? Well, you may have kind of seen to this point why it would be, but do you remember last week, when we were talking about the 30-year mortgage, I was talking about all of the bad arguments for the 30-year mortgage. Well, one of those bad arguments was that you would have more opportunity for financial balance. And what they said was the higher payment that comes with a 15-year mortgage makes little sense if it leaves you unable to build an emergency savings or contribute anything to your 401k, IRA, and perhaps your kids' college funds. But what did I say? I went about saying that you can still invest with your mortgage as a reasonable percentage of your income and then invest a lot more once the mortgage is paid off. And I still stand by that, especially since they were bringing up things like emergency funds. We should already have our emergency fund set if we're in this place. So that's not even a consideration. And you should be able to invest and pay off your mortgage at the same time, therefore doing both things and making headway in both places. Now, the conflict really comes in the fact that people do math, right? And what does the math say? I mean, I myself am a math nerd. I'm getting a PhD in finance. I've done more calculus and statistics than I care to mention, okay? But I don't follow the math absolutely directly here because I know this is a behavioral thing. But what is the math argument? Well, the math argument is the difference in the potential rate of return of investments versus the cost of the mortgage. And people will say, well, the mortgage only costs 3%. And the investments can earn you, 10+%, if you invest in certain things. So how, would you forego investing and put money on this 3% mortgage? Well, I will tell you why. Number one, I want to own my assets. I don't want to be in debt. I want to own my assets. But apart from that, that's not the absolute best argument. That's just an opinion. But apart from that, this does something behaviorally when you own your home. When you own your home, you feel different. You can do things differently. You feel like you have, climbed Everest financially. You have done the thing that most people feel like they cannot do, and you have thrived financially. And that's something that you're just not able to feel if you just continue to allow yourself to systematically invest and just put minimums on the home. That's not something that, is going to be super beneficial to you. But even greater than that, something that is not done in that argument is there is no risk adjustment in this argument. So what do I mean? Well, we adjust other investments for risk, right? Like we know that market investments have substantially more risk than a mortgage. So those mortgages will obviously have lower rates. Obviously, you're not going to have a mortgage that is as high as the rate of return on growth stocks. It's obviously not going to be that way, right? But that's not a reason to take advantage of the growth stocks in lieu of paying off the mortgage. And why is that? This would be like comparing a treasury bill, which is the risk-free asset, right? Something with very low risk, or a treasury bond, a low-risk government bond. This would be like comparing that with stocks. And it doesn't make any logical sense because we all know that the risk associated with investing in stocks is greater than that of investing in treasury bills, right? So therefore, what do we expect? We expect higher returns out of stocks. Well, in the same way, we expect higher returns in market investments like stocks and bonds than we do in a mortgage. We expect the mortgage rates to be lower. Because most people pay their mortgages. Mortgages are relatively not so risky for banks, okay? And given that this is the case, and regardless of what the math nerds say, your life changes when that house is paid off. And I want your life to change financially. And your life financially will not change if you don't make that particular step. You don't take that step into financial freedom. I told you last week, that is the most financial freedom that you can feel is when you get to that point where you have paid off your home and you can breathe. You can step on that lawn and know that that lawn is your lawn and that grass feels good underneath your feet. It's just a different thing. And yes, I get it. The math, right? The math. But guess what? Once you pay off your home, invest your heart out. That's all I'm saying. And I'm not saying not to invest. Obviously, I said to do both and do them both in large percentages. You're not going to fall behind doing what I'm telling you to do. You're actually going to feel like you got ahead because you paid your home off early and you made that big step to where when you get to retirement or when you get to later in life, you don't have that large expense. In most people's cases, it is harder to come up with the income that can be created to maintain them in retirement than it is to decrease the expenses. So it's harder for them to come up with the income. So the best thing to do is to decrease the expenses. Well, how do we do that? Well, one way is pay off the home. You don't have any housing costs directly. Well, if you can decrease that expense, then you need less income. There are two sides to the particular sheet that we're talking about here. There's two sides to the equation. There is income, there is outgo, there are expenses. Then we need to take them both into account, not just the one. And so I'm really taking that expenses into account along with the income, because we have to have both. And this is in the form of investments, and the expenses obviously are in the form of the mortgage. So you need to be doing both. You need to have that financial balance in your life, but make sure that they both get done, and both get done with a lot of intensity and ferocity, and you can really move forward financially knowing that you're set up for retirement, your kids are taken care of, their colleges are taken care of, you've done good bridge investing, and you pay off your home. That's what we all want, and so that's what I want you to continue pushing towards in your financial life. In the financial world, there are very commonly these conflicts. There's the Roth versus traditional argument. There is the 30-year versus 15-year mortgage argument, which is part of this argument that we're talking about here. And then there's the invest or pay more on your home argument. And so all of these arguments, there are smarter choices, but there's not an absolute right. There's not an absolute correct. That's why people continue to argue over them. But I gave you what I feel like is best for you to do. I'm telling you what I am going to do, how I am going to manage my finances moving forward, and how I'm going to continue pushing forward in the financial action plan in this way. So I wouldn't tell you to do anything that I wouldn't do, but it doesn't mean that you're absolutely wrong if you do things in a different way. I want to really hammer that home, that you can do things slightly different and get to still a very successful, very financially free place. I just want to be the most efficient that I can, and I want to change behaviors and change the way that we go about looking at our finances. And in order for that to happen, I really want to be out of debt, and the home does get in the way, so I want to be paying that off, as well as making sure that I'm growing and compounding my money forward in investments over the long term. So there is no wrong answer, but you get what I think, and you get that I think we have to be doing both of these things in order to be financially successful. So hey, don't forget to subscribe to my channel, like this video, hit the big thumbs up. Also, go down below, leave me any feedback in the comments, any questions, comments that you have. I will be sure to get back to you there. If you are listening to this on Apple or Spotify podcasts, please subscribe there and leave me a review if you can. That would be really, really helpful. Follow me on social media at MNO with Dylan. That's a fantastic follow, and I'll be able to teach you day by day through the posts that I make there. And you can be getting information from me, not just through these videos, but through the social media accounts as well. And then, lastly, if you want to work one-on-one with me, if you want me to help you build a financial plan that will work well for you, then you can go to my website, www.mnowithdylan.com, click on the Work with Dylan tab, and choose the financial coaching session type that would work best for you. And we can begin working together and build this relationship, and you can find out what's best for you financially and start pushing forward with a lot of intensity in your own financial life. So tune in tomorrow as I talk about how you can catch up on your retirement savings if you have fallen behind, or if you just don't feel like you have enough moving towards these later stages in life. So we'll talk all about that in tomorrow's video. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.